Everyone told Sarah she was throwing money away. She'd been renting the same two-bedroom apartment for 3 years. Her friends had bought. Her parents kept asking when she was going to stop paying someone else's mortgage. Her coworker sent her a TikTok that said renting was the biggest financial mistake a person in their 30s could make. And Sarah, tired of hearing it, finally sat down and ran the numbers. What she found didn't just surprise her. It changed the entire way she thought about the decision. Because here's what nobody is telling you about the rent versus buy debate in 2026. The conventional wisdom that's been drilled into an entire generation was written for a completely different math environment. And if you're making this decision today, using the old playbook could cost you more than you realize. Today, we're going to run the actual numbers. Not the mortgage payment the bank puts in front of you, but the real all-in cost of owning a home in 2026, compared side by side with renting and investing the difference. The results are going to make some of you very uncomfortable, and a few of you are going to feel a whole lot better about where you're living right now.
Let's start with a number almost nobody talks about. The national median home price in March 2026 is $408,800. That's the midpoint. Half of homes sold for more, half for less. Now, to buy that home with a 20% down payment, you need $81,760 just for the down payment. Add closing costs, which run 2 to 5% of the purchase price, and you're looking at another $8,500 to $97,000 before you've signed a single piece of furniture. Total cash required to walk through the front door as an owner, somewhere around $93,000 to $97,000. That's money that leaves your account on day one and doesn't come back until you sell. Now, let's talk about the monthly payment. The 30-year fixed mortgage rate as of late May 2026 is sitting at 6.53%. On a $327,000 loan, that's the 408.8 minus your 20% down, your monthly principal and interest payment is approximately $2,075. That's the number the bank hands you. That's the number you're probably mentally comparing to rent. But here's the part that matters. That $2,075 is not what homeownership costs, not even close.
You also owe property taxes. The national average effective rate is about 1.1% of your home's value per year. On a $408,800 home, that's $375 a month, every month, whether the market goes up or down. Then there's homeowners insurance. The national average in 2026 is $2,490 per year, about $208 a month. And then there's maintenance. The standard rule of thumb used by every financial planner in the country is 1% of your home's value per year for upkeep. On a $408,800 home, that's $340 a month set aside for the water heater that breaks, the roof that leaks, the HVAC system that quits at the worst possible time. Add it all up. Mortgage, taxes, insurance, maintenance. Your real all-in monthly cost of owning that median home is approximately $3,002 per month, not $2,075, $3,000. Now let's look at Sarah. Sarah is renting a two-bedroom in a mid-size metro. She's paying $1,850 a month. That's right around the national average for a comparable unit in 2026. Her total monthly housing cost, $1,850. The gap between what Sarah pays and what she would pay as a homeowner on a comparable property, $1,152 per month, every single month. That's the number almost every rent versus buy comparison quietly buries.
But here's where it gets really interesting, and where the people who've been calling Sarah foolish go very quiet. Sarah has that $93,000 she didn't spend on a down payment and closing costs. And every month, she has $1,152 left over compared to what she'd be paying as a homeowner. The question isn't just whether she's building equity. The question is, what happens if she actually does something with that money? Sarah puts the $93,000 into a low-cost S&P 500 index fund. The historical average annual return of the S&P 500 after inflation is approximately 7%. At that rate, Sarah's $93,000 grows to roughly $183,000 in 10 years. She didn't buy a single square foot of house. She also didn't call a plumber once. Now add the monthly savings. If Sarah invests that $1,152 gap every month for 10 years at the same 7% return, that contribution alone grows to approximately $197,000. Combined with her initial lump sum, Sarah's financial position after 10 years, approximately $380,000 in liquid, accessible wealth, money she can use, move, or redirect without selling her home or applying for a HELOC.
Now let's run the same 10 years for Michael, who bought the median home. Michael bought at $408,800. He put 20% down. He's been paying $3,002 a month all in. His mortgage balance after 10 years is roughly $271,000. If his home appreciated at the historical national average of about 3.5% per year, his house is now worth around $576,000. His equity? $576,000 minus $271,000 equals $305,000. That sounds impressive, until you factor in what he actually spent to get there. Over 10 years, Michael paid approximately $130,000 in interest to the bank, $45,000 in property taxes, $25,000 in homeowner's insurance, and conservatively $40,000 in maintenance and repairs. That's $240,000 in money out the door that built zero equity. It paid for the bank's interest income, the county's tax revenue, and the HVAC company's new van. His net financial position after 10 years, $305,000 in equity, but $240,000 spent on carrying costs that vanished. Compare that to Sarah's $380,000 in liquid wealth, built with no maintenance emergencies and no money trapped inside walls.
And here's the thing nobody wants to say out loud. Michael's $305,000 isn't liquid. It's locked inside his house. If his car needs replacing, he can't swipe his home equity. If a medical bill shows up, he can't log into his equity account and transfer funds. To access that money, he has to sell the house, which costs another 5 to 6% in agent commissions and transaction fees, or take out a home equity line of credit, which in 2026 is running at 8 to 9% interest. The wealth is real, it's just imprisoned. Now, before you think this video is just anti-home ownership, stop, because this is where the math gets more complicated and more honest. The scenario we just ran works when two things are true. One, you're in a market where the monthly cost of owning significantly exceeds the cost of renting a comparable property. Two, you actually invest the savings gap. If either of those conditions breaks down, the math breaks with it. In Chicago right now, the monthly cost of owning a median home is actually lower than renting a comparable unit. Detroit, Cleveland, Indianapolis, there are markets, mostly in the Midwest and parts of the South, where buying wins on monthly cash flow immediately. In those markets, Michael comes out ahead, often by a wide margin. In Los Angeles, where ownership costs run nearly double the median rent, Sarah wins decisively.
There are also two things renting can never give you that ownership can. The first is rate lock. Sarah's rent is going up, maybe 3%, maybe 5% a year. Michael's mortgage payment is frozen at $2,075 for 30 years. In year 20, inflation will make that payment feel like almost nothing. In year 30, Sarah might be paying $3,200 in rent for the same apartment she paid $1,850 for today. Michael is still paying $2,075. The second is forced savings. A lot of people, if they have the extra $1,152 a month, don't invest it. They spend it. The mortgage is a savings vehicle with no opt-out button. For people who struggle to invest consistently, that forced equity accumulation has real value, even if the math doesn't look clean. So here is what the rent versus buy decision actually comes down to in 2026. Not feelings, not family pressure, not the idea that you're throwing money away. 3 questions. First, what is your local price to rent ratio? In expensive coastal metros where homes cost 25 to 30 times annual rent, renting wins mathematically in the short and medium term. In affordable Midwest and Southern markets where homes cost 15 times annual rent or less, buying often wins on monthly cash flow immediately. Second, how long are you staying? Below 5 years, renting almost always wins. The transaction costs of buying, closing costs in, agent commissions out, are too expensive to recover in that time.
Between 5 and 7 years is where 2026 math puts the break even for most markets. Beyond 7 years, the picture shifts increasingly toward buying in most markets. Third, will you actually invest the savings gap? If the answer is yes, consistently, in a low-cost index fund, the math on renting is often better than anyone wants to admit. If the answer is no, the forced savings mechanism of a mortgage may serve you better regardless of what the spreadsheet says. Sarah isn't throwing money away. She's building wealth differently. The question is never rent or buy. The question is always, given your market, your timeline, and your financial habits, which path actually builds more wealth for you? And in 2026, for more people in more markets than at any point in the last decade, the honest answer to that question is not the one most people expect.